concentrated areas in the world, we take a very global approach. So we have a significant amount of the portfolio, not necessarily in just Australia, but North America as well, some Latin America. But we basically look at these gold miners from an approach of basically an equity investment, right? We are not taking a bet necessarily on where gold prices are going to be. We factor into our accounting what gold prices might be, but the reality is we are interested in picking gold miners that have healthy fundamentals, that will be able to operate at a very profitable rate and be able to extract ore at a much cheaper cost than their competitors. We're basically looking for companies that have high quality mineral deposits and are able to extract that at a lowest possible cost. So basically, we're looking for experienced management teams over the longer cycle. Now, one of the good things is that by gaining exposure to this asset class, it has very low exposure, or it has very low correlation to other sort of asset classes. And by being able to express our interest by way of miners, we actually have a more levered return that we can get rather than just buying the metal itself.
Indeed, this is an equity asset class that has very low correlation to your usual growth, high growth, or your tech equities or your other sector equities. Now, Will, Franklin Templeton has a very competitive fund that captures such opportunities in listed mining companies. In fact, this fund itself, year to date, as of the 28th of May, that was yesterday, it's already up by 60.1% in US dollar terms. Could you share with us a little bit more on its features, please?
Yeah, definitely. I have a guilty confession. I stopped looking after we crossed 55. So the fact that we crossed 60, like, yeah.
There's
So
still room to grow.
still room to grow. Um, I think what makes us, kind of unique in our approach is that we have a very long-term history of operating in the space. The fund the strategy was started in 1969. The CCAV, which is applicable in this region of the world, that was founded a little bit more recently, 2010. But having said that, the CCAV doesn't reflect any differently in terms of its approach. We picked the stocks the same exact way as the original fund that was launched in 1969. Now, we take a fundamental approach. We focus on growth, quality, and value. Those are the three characteristics and lens that we use when we look at these companies. And as I mentioned before, we're really focused on finding mining companies that are both sustainable. Certainly, there's a focus on being able to identify mines that will produce for a long time, but we are also focused on trying to identify smaller companies. That's a little bit of a differentiated feature. If you consider something like gold mining benchmarks, typically they have a lot more concentration in mines that are already producing, that have long lives, anywhere. When we say long, we tend to think of it as 8 years or more. But we are actually underweight that segment. We try to focus more of our attention on smaller cap names, smaller miners, and I think that's a little bit of a differentiated point that's helped contribute to returns. So if you think about investing in general, right, smaller cap names typically have a little bit more upside or leverage when markets start to rally. And we see the same effect when gold starts to rally. You see some of these smaller miners that maybe have projects that aren't in production mode yet. They stand to benefit because all of a sudden it becomes more profitable for these to come online. And as long as you have an efficient way of extracting that ore from the ground, there's plenty of upside when gold prices are much higher. And then the last point, Eugene, which you kind of mentioned already, is that by taking a gold equity exposure relative to other equities, these sort of companies have a much lower correlation. So when you think about portfolio construction, it's one way of gaining an exposure that's uncorrelated to other assets and sectors. Now, in terms of the team, one of the differentiated points is that, in addition to Steve Land, who's the lead portfolio manager here, Fred Fromm also works on the strategy. The interesting thing about Fred is he actually runs our he runs another fund that's actually very similar to this. He runs the Natural Resources Fund. So there's actually a lot of synergy between these two portfolio managers. Fred focuses on extraction energy, extraction industries such as oil and gas, oil field services, and a lot of the same sort of themes that he sees, kind of helps to us inform us when it comes to the gold and precious metals funds. Now, one other thing that I think is a key component and strength is that when it comes down to research for the fund, we actually leverage a team of 35 research analysts that are focused on growth. Now, typically, mining is not a what you consider a growth industry. Most people think of something like tech. That's a little bit, higher beta. That's a little bit more modern. I'll share with you a couple examples maybe a little bit later, but we do have that growth lens when we invest, and it bleeds into our investment process as well. So, how we look at opportunities, as I mentioned before, we are focused on quality growth and value. One of the things, even when it comes to miners, that we're really keen on focusing on is the growth potential for these miners. Now, when we say growth, what does that really mean? It means a company that is sustainable over the longer term, that has reserves where they can continue to extract that for many years to come, and a company that ultimately will have upside to their earnings because of the ore that they have underground. Now, the other aspect for growth, which I mentioned, is that there also is a bit of innovation, right? So when we think about other names that we have in the portfolio, certainly we are focused on gold miners, but we also have investments in other companies that help gold miners basically extract ore more efficiently. That helps to increase yield, that makes sure that miners have less of an environmental impact. All things that are pretty important when you think about the impact to the earth, especially as there's an increased focus on ESG and safety. Now, what are some of those things that are helping miners be more productive versus their other peers? Big data and AI. So when we think about some of the larger companies that have data sets, they can basically leverage AI to make predictive estimates as to where gold ore deposits are basically found underground. When we think about automation and we talk about physical AI, increasingly mining companies are using basically automated and remote controlled equipment to be able to drill more accurately. If you're able to drill more accurately, it means you can get more out of the ground without just basically taking rock to the surface, right? It's pretty wasted if for every ton of rock that you extract out, maybe only 20% of that is gold. It's better if you drill more accurately and you extract 1 ton of rock, but maybe 80% of that is gold. So all these sort of things, ore sorting, assays that are able to be done more accurately mean you can quickly identify the quality of the ore that you're taking out. So if ore that you're taking out isn't very productive, you'll stop efforts and start looking elsewhere for more higher quality deposits. So that's when I talk about growth and innovation, that's a little bit of how we're injecting our growth and innovation DNA, even when it comes to industries such as gold mining. Now, when I talk about quality, it's really in the management companies, right? There's a couple examples of portfolio names where we have followed managements. So when you have a quality management company move across from one company to another, we tend to follow and track them. Performers that have done well typically continue to do well. So we are quite keen on making sure that the companies that we invest in have quality management companies that know what they're doing. And then last but not least, when it comes to valuation, it's something that we're quite cleanly focused on. We don't want to overpay for these companies. When you look at the history of gold and extraction industries in general, typically they are seen as potentially boom bust. So there is overdevelopment over time. And basically what ends up happening is overdevelopment leads to oversupply and then a contraction. Now, what we've seen in the gold space is that it hasn't been as aggressive lately. Gold miners have been much more conservative in terms of their expansion and their production. So we see a little bit of a difference versus in the past, which we're a little bit more positive on. But we are still very mindful of what we're willing to pay for these companies. We don't want to overpay for them for something that has a bit of sensitivity. And then Maybe just a quick summary of kind of what I've outlined so far. The fund is really focused on a differentiated exposure to gold. We are focused on miners and gold equities. The fund is not invested in spot gold. So for that reason, there is a loose correlation between the price of gold as well as the appreciation potential for the fund, but it will not track one to one. One of the important things I want to continue to highlight is that gold miners will have leveraged exposure, both to the upside and the downside. So if all of a sudden gold prices continue to, if they all of a sudden start to retreat, you will start to see revisions lower for some of these miners. Now, having said that, gold miners can also be a little slightly more defensive, right? There's a little bit of a lag in the sense that if all of a sudden gold prices start to come down, gold miners have already budgeted in a budget in terms of what they can extract. Now, one of the other things, is that gold miners relative to bullion actually pays dividends. So one of the good things about gold miners relative to spot gold is that you can actually receive dividends from some of these mining companies as opposed to gold, which doesn't pay any dividends. So when it comes down to investing in gold miners, we focus on pure equity exposure. We are long term in our focus, and then we are also focused on the growth potential of these miners as opposed to just the spot price of the commodity.
Right, Will. An interesting point that you pointed out that you mentioned earlier on is the correlation of the fund versus the spot price of gold, if I heard you correctly. Now, um, there is another perspective, there's a correlation on the number of holdings we have in the fund versus the spot price of gold. Now, could you share with us on this interesting approach and also the diversification benefits of this approach?
Yeah, definitely. You're absolutely spot on. No pun intended. I think the phenomena that you mentioned goes back to what I mentioned before, right? So as you have the price of gold go up, some of these what I'll call early stage mining companies become more and more interesting, right? If at $1,000, there's only a couple miners that are generating profits, that have projects that are profitable. If all of a sudden gold prices increase significantly, now to say $3,000, well, all of a sudden mines that were maybe unprofitable could be profitable. And so basically, we are focused on identifying some of these smaller opportunities that may not be producing yet, but all of a sudden, as gold prices increase, we are looking to expand our bets into some of the, or expand our investments into some of these smaller companies that might all of a sudden have profitable projects that they couldn't access when gold was at a much lower price. And part of what we do, we take a much more diversified approach. So when gold prices increase, we increase the number of holdings in some of these smaller cap names. But because gold prices are increasing, it becomes more profitable to open up more and more of these projects. But in order to diversify, we want to make sure that not a single mine, if there are mines that ultimately don't become productive, we want to hedge that by taking additional positions in some of these smaller miners. So the increased number of holdings basically reflects that diversification.
And what about towards other asset classes?
Yeah, I mean, as you can see here, generally very low. Relative to what I think most people are typically invested in, which would be public equities and public fixed income, is a very low correlation. The highest correlation that we'll see is really corporate bonds. Part of that is the defensive nature. So if you think about the fact that in periods of market volatility, people tend to tilt away from equities and people will typically move into fixed income. What we mentioned before, right? Gold typically has defensive characteristics. So, which is why you see a little bit more correlation directionally when it comes to corporate bonds and gold. That's a little bit more from its defensive perspective. But across all asset classes, there's not one over here that exhibits any sort of meaningful positive correlation. If nothing else, this is a good diversifier for portfolios.
Sure. Thanks. Maybe just a very quick run through on our fund's positioning and what can we expect from the Franklin Gold and Precious Metals Fund?
Yeah, definitely. So, in terms of positioning, as I mentioned before, we are quite diversified, and we're quite different from the benchmark. That's one of the things I would quickly highlight. Um, when we think about our geographical exposure, we're well diversified across the world. We don't necessarily look like the index in that regard. When we think about market cap, we are also not reflective of the benchmark. We tend to have more weight in some of these smaller mining companies that don't necessarily have mines that are up and running just yet. And we have less weight in these long life gold mines, which the benchmark has significantly more weight in. If you think about the benchmark, almost 80, yeah, roughly about 80% of the benchmark is comprised of these long life gold names. So those are the large miners that I think most people are familiar with. They're already producing, and they're fairly stable. We are actually underweight those names. Where we have a significant overweight relative to the benchmark is a little bit in these gold exploration and development names. Again, these are similar to, if you're familiar with the kind of oil industry, the wildcatters, the people that are going out there to explore and find new mines that might be sitting on properties that haven't been developed for production just yet, that are maybe on the cusp of producing, and then could really stand to benefit. There's a lot of leverage if gold prices rise, because all of a sudden these projects and these properties that they sit on is worth a lot of value. It's basically a call option in some ways on the underlying properties that they hold.
Right.
And then, yeah, sorry, go ahead.
Yeah. So I guess a lot of these details can also be found on our website, franklintempleton.com.sg. So I won't go through them in overall detail. But just to take note, in terms of the volatility expected from investing to such a vehicle, if you look at this chart over here, this table over here, the standard deviation of fund averages at about 30% for the past 3 to 5 years. So indeed, this has a much higher volatility profile compared to the likes of, say, a technology fund or a pure US equity fund. So investors, if you wish to asset allocate a certain portion of your investment portfolio into gold, you have to be prepared for the volatility of this particular product. Right. We've crossed the 35-minute mark right now, and I thought it would be a good opportunity for me to summarize this entire session before we head on to Q&A. Now, again, the goal itself can be summarized into 5 key points, as what I mentioned at the start of this presentation. Number one, it is a very good hedge against the US dollar, as most often gold prices will move inversely to the US dollar. Number two, it provides inflation protection. I mean, it's a good hedge against inflation. Number three, very good diversification too, as what Will has mentioned over the past half an hour. This is due to this low correlation with other major asset classes. Number four, it has a safe haven status, providing stability during economic instability, especially in a Trump 2.0 environment where tariffs are still uncertain, whether or not Trump's going to implement tariffs and other asset classes are going to be impacted. Definitely gold is something for you to consider. And last but not least, gold is definitely a universal currency that stores its value really well. Thank you so much, Will. And I believe we have a number of questions that just came in on the chat. And if I may just address a few of them. Um, no, there's a this is an interesting one. Streaming royalty companies. I'm not so sure what that means. Will, do you know that?
Yeah, so typically it's not a primary focus of the fund. We are really kind of focused um, on companies just really focused on extraction. And streaming and royalty companies are not a typical focus for the fund. Um, a lot of kind of our focus is really identifying companies that will be able to produce gold for a long time. And typically, where we want to be invested is early on in that process, which gives us a little bit more leverage and reflects the performance that we've seen this year.
Right. Thank you for that. A couple of questions asking about peer comparisons. Now, I think I can take that. Now, how different is this fund from the BlackRock World Gold Fund and the United Gold and General Fund? Okay. Now, all these funds are our competitor funds. We share similar strategies, i.e., these are pure equity funds buying into gold mining or precious mining related companies. The difference is probably in our investment process, as what Will has mentioned earlier. Our fund managers have been around for a very long time, and the strategy has been around for a very long time, and this is backed up by a team of highly specialized research analysts that enable us to keep this fund performing competitively. From a Sing dollar perspective, and I'm looking at some numbers over here, from a Sing dollar perspective, year to date, our fund is up by almost 45%, and we have actually performed much better than the two mentioned peers. In fact, last year itself, for calendar year 2024, our fund in Sing dollar basis has performed about 22%. The other two mentioned funds did not perform as well. So yeah, so I hope that answers the question. Again, on the Philip Poem site, you can download the fact sheets of our fund as well as the other mentioned funds from BlackRock and UOB Asset Management, and you can see the differences in the composition, but they are relatively in the same category of buying into mining companies. Okay, Will, this is a good question. What constitutes precious metals?
Yeah, definitely. So in addition to gold, platinum would be another one. Rhodium would be another. Some of these have a bit more specific industrial use. But basically, when you extract gold out of the ground, you never really just get gold. You get gold, you usually get a mix of different alloys and ores. So typically, uh, even though you may be called a gold miner, there are other metals that also get extracted out of the ground as well.
Right, and maybe just for clarification purposes, what percentage of our fund is invested into, pure gold miners?
Uh, that's a that's a really tough one. I mean, there's a the only reason I say it's a difficult question to answer is because there's nobody that says we only do gold, right? Gold will be
Yeah.
a majority of a project, but you get a lot of other ores that also come out of the ground. So if I were to think about what is my pure gold extraction, I can come back. We can run the calculation, but it's really difficult to find the exact
Right.
answer to that.
Okay, sorry putting you in a spot, but
No problem.
if I'm right to say that the strategy is predominantly in gold mining companies, and the lesser minority will be that of precious metals, right?
Correct. That's
And of
correct.
course, with gold mining companies, when you in the extraction of gold, you get a lot of byproducts, you get a lot of other metal components as well. And
Mhm.
this is also sold as a product by these mining companies. Will, maybe just a macro question from me. Looking at the way the U.S. economy is headed to right now, I mean, at the start I mentioned that U.S. equities are going up and down in the roller coaster ride. We saw tech stocks correcting massively and then rebounding back again. Gold has risen plus minus 40 to 60%. What's in for us for the next 6 months towards the end of 2025? Maybe just what's your take on the tariff situation and what do you think Trump is going to do next?
So you're lucky I have my crystal ball here. All joking aside, it's challenging, right? I'll outline kind of where we think key catalysts might be, but I think even news that we saw earlier this morning, I mean, late last night out of the U.S., it's been really difficult. There's been a lot of whipsaw back and forth developments. So you mentioned tech, for example, and tariffs. Last night, basically, it was announced that the one of the trade courts in the U.S. basically ruled that tariffs were improper, and basically said, okay, they're legal, they can't be implemented, and now the Trump administration is going to appeal that. But because it was seen as a pause, if not cancellation, of tariffs. I mean, it has to still make its way through the courts, but at least it's a temporary stop on tariffs. That was seen very positively by the markets, and I saw futures up almost 120 basis points overnight. So that's being perceived very, very positively by the markets. But similarly, I mean, you want to talk about the duration by which this market turns around. April 2nd, we had Liberation Day. April 9th, all of a sudden we had a pause on all tariffs, right, for a 90-day period. It's this sort of back and forth with the Trump administration that's creating a lot of the volatility. Another driver that we could see potentially influence the direction of markets is basically what the Federal Reserve is going to look like. They're basically on pause until, well, it was supposed to be the 90-day period, so July 8th, when there was supposed to be more clarity on behalf of tariffs. But now that kind of goes out the window with the latest ruling, right? July 8th may not be relevant anymore, especially if the courts rule that tariffs can't stand. But if the Federal Reserve cuts in the back half of the year, that could be quite positive for equities. Um, and then the last but not least, when we think about some of the Trump policies that he's talked about, not necessarily when it comes to kind of tariffs and overseas, but when we think about the more domestic policies that he's talking about, some of those things could also be positive for equities, right? We've already started to see the rough sketches and outlines of what a tax plan could look like. That would be positive for equities. But on the negative side, I think some of the policies that he's taken on immigration are seen as inflationary and potentially negative for the U.S. economy. So there's a little bit of kind of more headwinds kind of balancing the positive news that I outlined. So I think those are a lot of the sort of macro factors that we're thinking about. But I just want to maybe end my comments with the fact that, so far, US GDP continues to grow at a healthy rate. Based on the commentary out of financial institutions, the US consumer on the margin has maybe seen a little bit of weakness, but overall continues to remain resilient. We've seen inflation start to come down, which is positive for the Federal Reserve. So we're not too worried, but it's not necessarily straight into the right. There is likely to be a bit of volatility just given the policy directives coming out of the White House. But that's kind of what we see for the rest of the year.
Thank you for that, Will. And I don't see any more questions coming in, so I guess we can return 15 minutes back to everybody to have a good lunch. Nicole, anything else to add?
No, I'm good. Yeah, thank you
Right,
both so much for your presentation, Eugene and William. And thank you
right.
everyone for participating in today's webinar. And I
Thank
really
you.
hope everyone has gained valuable insights into your fund, the Franklin Gold and Precious Metals Fund. So just as a reminder to everyone here, I'll be sending out an email tomorrow with a link to Franklin's fund on our affiliate website. So if you're interested, you can check that out. And from our website, you'll be able to get the fact sheet, prospectus, and all the information about the fund there.
Right.
Yeah, if not, thank you so much, everyone. And thank you again, Eugene and William, for your time today.
Thank you, and take care, everybody. Bye-bye.
Thank you.
Recording stop.